Welcome to The Explainer. Today we're breaking down one of the absolute most powerful concepts for building wealth, tax-advantaged investing. And we're going to give you a really clear, actionable framework to navigate it, consultant style. So you know the feeling, right? You do all the work, you see some solid growth in your portfolio, and then bam, tax season rolls around and takes a huge bite out of those gains. It honestly feels like you're taking 2 steps forward and 1 step back. But what if you could legally build a shield around that growth?
Well, you can. And look, this isn't about finding some obscure, shady loophole. It's about using the system exactly as it was designed. We're talking about tax-advantaged strategies, a whole suite of incredibly powerful tools that let you grow your wealth while keeping your tax bill to a minimum. This is the strategic edge we're going to map out for you today. All right, here's our game plan. First, we'll nail down the core tax advantage principle. Then, we'll get to the one big decision that frames everything else. Should you pay now or pay later? After that, we'll open up the retirement playbook, look at some awesome tools beyond retirement, and learn how to navigate the rules of the game. And finally, we'll pull it all together to help you choose your best path.
Okay, let's start at the very beginning with the core concept, the tax-advantaged principle. Before we get into all the different accounts and strategies, we need a rock-solid foundation. We need to understand what tax-advantaged actually means and why it's such a massive lever for building wealth.
So, what are we really talking about here? At its heart, tax-advantaged just refers to a set of financial tools. Think of them as special accounts or investments that give you a break on your taxes, either through exemptions or deferrals. The whole point is to let you optimize your savings and legally shrink your tax bill. This allows your money to compound way more powerfully over time. It's really the difference between rowing a boat against the current versus having a strong current pushing you forward.
Okay, so this leads us to a really powerful way to simplify everything. You see, this entire kind of complex universe of tax-advantaged strategies, it really just boils down to one fundamental choice. And if you get this one choice right, it unlocks everything else we're going to talk about.
And this is it. This is the choice. On one hand, you have tax deferred. That's your pay later option. You get an immediate tax break right now, which is awesome, but you pay the taxes down the road when you take the money out. On the other hand, you have tax exempt, the pay now option. You use money you've already paid taxes on, so there's no upfront deduction. But, and this is a huge but, all of your growth and all of your withdrawals in the future are completely tax-free. This is the core framework we're going to use from here on out.
So now that we have that pay now or pay later framework locked in, let's open up the retirement playbook. We're going to see exactly how this choice applies to the most common tools that people use to save for the future. Let's kick things off with the pay later path, tax-deferred accounts. You've definitely heard of these. We're talking about a traditional IRA or a workplace 401k. The way it works is you contribute money before taxes are taken out. This instantly lowers your taxable income for the year. Then that money and all the interest and gains it earns gets to grow in a tax-sheltered bubble. The tax bill only comes due way down the line when you start taking the money out in retirement.
Let's make this super real for a second. Let's say your taxable income is $50,000. If you put $3,000 into a traditional IRA, you can deduct that entire amount. And just like that, you're only paying income tax on $47,000. That right there is the immediate power of going the tax-deferred route. You're getting a government-subsidized boost to your savings right now.
All right, now let's flip the coin and look at the other side of our framework, tax-exempt accounts. This is the pay now path, and the superstar here is the Roth IRA. With a Roth, you contribute with after-tax dollars, which means you don't get that nice upfront deduction. But the magic happens over the long haul. Your investments grow completely tax-free, and when you pull that money out in retirement, every single penny is yours to keep, 100% tax-free. And this is where you see the real power of that pay now strategy, tax-free compounding. Let's say you invest $1,000 in a Roth account. Over 30 years, that could grow to almost $2,500. That extra $1,427 is pure untaxed growth. Now, if that were in a normal brokerage account, you'd owe capital gains tax on all of that profit. But in a Roth, it's all yours. That is a massive advantage over the long term. All right, so we've nailed down the big retirement accounts. But here's the thing. This whole idea of tax advantage doesn't stop with your 401k or IRA. So let's move beyond just retirement and explore a couple of powerful strategies you can use in your regular investment portfolio. A classic example here is municipal bonds, or munis, as you'll often hear them called. When you buy a muni bond, you're basically loaning money to a city or a state so they can fund public projects, things like new schools or bridges. Now, to encourage you to loan them that money, the government gives you a fantastic incentive. The interest income you earn is completely tax-free at the federal level. And if you're really smart about it and buy bonds issued in your own state, that income is often free from state and local taxes too. For investors in high tax brackets, this triple tax-free advantage is a really big deal.
Okay, another really powerful tool, especially if you're into real estate, is depreciation. Now, stick with me here because this one can feel a little backwards at first, but it's a huge deal. The IRS basically lets real estate investors deduct a portion of a property's cost every year for wear and tear, and you can do this even if the property's market value is actually going up. Think of it as a paper loss that can cancel out your real rental income. This deduction lowers your taxable income every single year, boosting your cash flow. It's one of the key reasons real estate can be such a tax-efficient investment.
Now for a really, really critical piece of this puzzle: navigating the rules. These tax advantages are amazing, but they are not a free-for-all. They come with very specific regulations, and this is the key part: those rules are always changing. New laws can create new opportunities or completely change the strategy you should be using. So staying informed isn't just a good idea, it's essential. And this timeline, it's a perfect example of what I'm talking about. It shows how the age for required minimum distributions, or RMDs, has changed. That's the age when the government makes you start taking money out of your tax-deferred accounts. For years and years, it was 70 and a half. Then the Secure Act pushed it to 72, and Secure 2.0 pushed it again to 73. Every one of those changes directly impacts your financial plan by changing how long your money gets to grow tax-deferred. It's the same thing with contribution limits for IRAs and 401ks. They change almost every year. If you miss these updates, you could be leaving money on the table. Okay, we've covered a ton of ground: the principles, the tools, and the rules. So in our final section, let's bring it all home. Let's get to the so what. How do you actually turn all this knowledge into a concrete, personal decision? This is probably the single most common fork in the road for savers: Roth or traditional. Pay the tax now or pay it later. The thing is, the answer isn't the same for everybody, but it almost entirely hinges on one crucial forecast you have to make about your own financial future. This little framework here really breaks it down for you. If you think you're going to have a higher income and be in a higher tax bracket in the future, then the Roth path makes a ton of sense. The logic? Pay your taxes now while your rate is lower. But if you expect to have a lower income and be in a lower tax bracket in retirement, then the traditional path is probably the more logical choice. Get that tax deduction now while your rate is higher. Of course, nobody has a crystal ball. You have to think about your career path, potential changes in tax laws. It's a strategic forecast, not a perfect science. And it's really worth remembering the why behind all of this. These programs exist for a reason. Governments create these tax advantages to encourage all of us to save for things that are in the public interest, like having a secure retirement. These aren't loopholes. They are intentional policy tools designed to help you succeed. So there you have it. We've built the framework, we've looked at the tools, the rules, and the key decisions. The map is now in your hands, and that gives you the power to make much more strategic, much more tax-efficient choices for your future. The only question left is, what's your next move going to be?